Decoding cash flow financing. How to really get fast and easy business financing even with bad credit. From Wikipedia, revenue-based financing or royalty-based financing, RBF, is a type of financial capital provided to small or growing businesses in which investors inject capital into a business in return for a percentage of ongoing gross revenues. Usually, the returns to the investor continue until the initial capital amount plus a multiple, also known as a cap, is repaid. Revenue-based financing is often described as sitting between a bank loan, typically requiring collateral or significant assets, and angel investment or venture capital, which involves selling an equity portion of the business in exchange for the investment. In an RBF investment, investors do not take an upfront ownership stake in the business. With this type of financing, you are basically selling your future revenue for a fee, a discount. Revenue-based financing goes by many names. RBF, revenue-based funding, revenue-based loans, revenue financing, cash flow financing, cash flow-based financing, cash flow loans, bank statement loans, ACH financing, royalties-based financing. When you see revenue-based financing advertised, these are the types of ads you'll typically see. Cash flow financing. Do you have $10,000 per month in gross sales? Quick and easy. Cash flow finance. Fast and simple, online application needed. $150,000 plus in sales. Profitable. How to get business financing when banks turn you down. Bad credit business loans. 24-hour approval. No startups, great rates, up to $500,000 quick. Fast small business loans, 24-hour approvals, online application, minimum $10,000 a month in sales to qualify. Although for many small businesses, this is a new concept. This has actually been used for many years in industries to finance the high upfront cost required in their industries. Hollywood filmmakers, oil drilling outfits, pharmaceutical companies. Revenue financing has always been popular for big industries with loads of revenue coming in. With these types of transactions, it's not uncommon to see 3 to 5 year terms. But recently, this type of financing has really ramped up for smaller businesses that aren't earning millions of dollars. So the new more common terms are 6 to 18 months. Revenue financing is not a loan. It's an advance off your revenue. It's very similar to a cash advance in the consumer world where your current pay is analyzed. You then are lent money based on the stability and amount of your pay. Then you have a short time to pay back what has been borrowed. With revenue financing, the lender will look at 2 main forms of documentation: your bank statements, your merchant statements if you have a merchant account. A driver's license is usually required. Rent, lease, or ownership information for the property is also verified. You can qualify even if you have a home-based business. Lenders are looking for very specific requirements when qualifying you. The bank statement is analyzed for consistent deposits, 8 to 30 per month. Lenders do not want to see only a few big deposits. Instead, they want to see many smaller deposits, such as a retail store would have, not a real estate agent. Lenders also want to see positive ending bank balances are also important. If you don't have money left over each month now, lenders know it will be tough for you to pay them back. So they are looking for positive cash flow each month. They want to see that the bank account is managed responsibly with little to no NSF charges. They also don't want to see a lot of chargebacks, which could reflect unexpected future expenses. Lenders have many restricted or high-risk industries. For example, the finance industry as a whole is restricted. Here's a typical restricted list you might see with many revenue lenders. The longer time you have been in business, the better your chances of being approved. Most lenders require you be in business for 12 months or more. There are some lenders who will lend you money if you have been in business for only 6 months. But in those cases, they usually want to see compensating factors. Personal credit is not a big factor of approval with revenue financing, but will tie into the terms you will pay. Lenders often approved business owners with scores as low as 500. Lenders are most concerned with you being in current trouble, such as an imminent bankruptcy or very recent liens and judgments. If you don't have those types of issues, you can get approved, even with recent collection accounts and late payments. This is one of the best types of financing to secure with credit issues. Revenue financing is not a loan, so there is no standard interest rate you will pay. Instead, you are selling your future revenue for a discount fee. For example, you might get a loan for $100,000. The lender then might charge a discount of 20%. Your total payback would be $120,000. If the lender were to finance the $120,000 over 12 months, your payback would be $10,000 monthly. Payments are withdrawn from your bank account daily, usually Monday through Friday. So you would pay back $500 per day, Monday through Friday, until the total amount is paid back 12 months later. The $500 is automatically deducted each day, so in many cases you won't notice it gone. You will usually be given choices where you can pay more of a discount and get a longer term, or pay less of a discount and get a longer term. Each option has a different daily payback amount. Usually the payback amount is 8 to 12% of the actual revenue. Most lenders charge more money and give you a shorter term in the beginning until you prove yourself. Then, when 50% of the amount is paid back, they commonly will renew the advance, giving you an even longer term and lower payback. For example, you have paid for 6 months of your 12 months current advance of $120,000, now owing only $60,000. The lender looks at 2 of your most recent bank statements and sees that you took the money and invested it into your company, and now your revenues have grown way more than what they were. They now lend you another $40,000. Your term is lengthened from 12 to 18 months. Your payback discount drops from 20% to only 12%. You already used $60,000 of what you borrowed. Now you still have access to the other $60,000 you had outstanding and another $40,000 they just lent you. $100,000 is renewed at 12%, making your total payback $112,000 on the second advance. Please note, this would mean you truly never did have to pay the full 20% you were originally charged. $112,000 at 12% for 18 months equals $6,222 monthly, or $311 per day. Revenue financing is basically a very risky cash advance. The terms will not be great or anywhere close to a bank loan. But you can easily get approved for revenue financing even when there is no way you could qualify with a bank. Let's take a quick look at revenue financing versus a typical SBA loan. SBA loans require good credit. Guidelines state 620 scores are needed, but you can't have derogatory credit, so you will really need a 700 plus type of credit profile for approval. With revenue-based financing, you can get approved with a 500 score and major derogatory credit items. With SBA, you must have collateral to offset the debt. With revenue-based financing, no collateral is required. With SBA, you must supply 2 years of tax returns, being in business 2 years or more. With RBF, you only need to be in business 6 months. SBA loans typically take 6 to 12 weeks to close. With RBF, you can close in 72 hours. SBA loans look at your entire business and personal aspects. With RBF, they are mainly looking at cash flow only. SBA requires extensive documentation including personal and business bank statements, personal and business tax returns, resumes and background checks, personal and business financials, projected financials, business plan, good personal, business, and bank credit, balance sheets and P&Ls, articles, licenses, leases, loan history, collateral. Revenue-based financing only requires good bank and merchant statements, rental and lease information. Loan amounts vary based on the current revenue of the business. You can usually secure as much as 10 to 12% of your annual revenue. So if you make $500,000 per year in revenue, you could secure approximately $50,000. Most loan amounts won't exceed $500,000 for most small businesses. You must have at least $120,000 in annual revenue to qualify. There are no upfront charges with revenue financing. You will be charged a discount based on risk. This discount varies widely based on risk factors. Rates commonly range from 8 to 45%. 20 to 30% rates are common. Charges are tax deductible. Factors that affect risk include time in business, bank account management, positive cash flow, industry, personal credit score, if you have passed successfully paid advances. Remember that term in months is more important to payment than rate in most cases. Once you prove yourself, you will get offers for longer terms and lower discounts. On this sheet, you can see what types of options you'll have when selecting revenue financing options. Notice how the factor rate you pay will increase with a longer term. So you can typically choose between a lower rate and shorter term or higher rate and a longer term. Typically, the higher rate and longer term will give you the most favorable payments. You can usually use the funds from revenue-based financing for almost any purpose. But this type of financing doesn't make sense just to get money and have it sitting around. It makes perfect sense if you need to reinvest money into your company for growth. Buying a new truck, buying a competitor, implementing a market strategy, other ways of using the money that result in company growth. Revenue financing is very easy and very fast to secure. Due to limited document requirements, you can get your initial approval within 24 hours. Once you sign the term sheet, a due diligence process takes place for 24 to 48 hours. During this process, they are looking for potential issues such as having outstanding advances you didn't mention, signs you are going out of business, verification that your renting owing arrangements are in good standing. If due diligence is good, you can close once this period expires. 24 hours to underwrite initially, 24 to 48 hours for typical due diligence, 72 hours to get funding. Expect 7 days in case of unexpected delays. Merchant cash advances work very similar to revenue financing. Loan terms are also commonly 6 to 18 months. Discount rates are typically higher, 15 to 50%. Credit and document qualifying requirements are very similar. With merchant advances, lenders are looking at your credit card transactions and deposits only. They will review your bank and merchant statements, but only your credit card transactions will be lent against, not other deposits such as checks. In many cases, you will be required to switch merchant account providers upon approval. Renewals also work the same with merchant advances as they do with revenue financing. You can typically be approved for an advance equivalent to 1 month's credit card processing volume. In summary, cash flow-based financing is perfect for a business owner who is looking for fast and easy money. The approval requirements are so lenient that most people can get approved only with having consistent cash flow. The initial terms are a little rough, but after 3 to 6 months you can renew and get significantly better terms in most cases. Future renewals are very easy and fast to get, usually only requiring 2 months' bank statements and getting advanced in 48 hours. Contact us today to learn more.